In this week's tutorial, we're going to take a look at the area of positive accounting theory. So we have two short questions, question 1 and question 2, focused on this theory. But just to kick off the tutorial, I'm going to look at a couple of key things you need to take away from positive accounting theory in terms of the key concepts. You can kind of structure your study and know the key aspects of this particular session. The first one is understanding the difference between normative versus positive theories. Right, so what is the difference between a normative accounting theory and a positive accounting theory? So again, normative, they don't look at current practice. What they look at is they prescribe what accounting should be. So how you should measure assets, such as the accounting measurement theories we looked at earlier. Whereas positive accounting theories, particularly this one, positive accounting theory, which is a theory itself, that looks to explain and predict, explain people's behavior. Why are certain accounting policies chosen by a company? Why are certain accounting policies not chosen? And predict what will happen in the future. So this is very much focused on the real world, real practice. This is abstract from the real world. It says this is the way it should be done. It may not necessarily be what's done currently. You need to understand the origins of PAT, which will include efficient market hypothesis and also agency theory. And we covered those in detail in class. So make sure you go back and think, well, where did positive accounting theory come from? The whole idea of efficient markets, that the stock market is efficient. It builds in the information as it's available into the stock price. But also this whole idea of the split between the principal and the agent, and the agency costs that arise, and the unanswered questions that efficient market hypothesis didn't answer, and where positive accounting theory stepped in. So you need to be able to explain those and understand where this came from. There's three key hypotheses. This is the bonus plan, the debt, and the political cost. Right, so you need to have an idea, what does positive accounting theory mean in terms of what does it predict? And it gives you three key propositions or hypotheses about the bonus plan, that managers, if they are paid a bonus based on profits, they will choose accounting profits or accounting policies to boost their profits. If companies have covenants based on debt and they have high levels of debt, companies will choose accounting policies to reduce the pressure on those debt covenants. And finally, the political cost hypotheses will say that companies who are large and who have a lot of political attention, they will seek to choose accounting policies to reduce that political attention. For example, choose policies to reduce their profits, not to increase them. So different hypotheses can predict different things depending on the scenario. And we will see that today in the tutorial questions, that you will be expected to apply your knowledge of these hypotheses to a practical scenario. And finally then, the last one, just bring this back, is the criticisms. So you have an idea of what the criticisms are in terms of positive accounting theory. The whole assumption around self-interest, the whole idea that it doesn't prescribe, it merely explains, so it doesn't really improve accounting. But having an idea of those, that remember, this is only a theory. It is based on a set of assumptions, and sometimes those assumptions you may not agree with. But that's the nature of all theories. They seek to expand knowledge, but within a certain boundary of assumptions. Right, so again, it's important that you go back, make sure you're happy with what the logic of positive accounting theory is. And remember, there is a chapter 7 available. Chapter 7 of textbook is available on Loop. Available on your Loop. All right, so that's important that you understand it's available there if you're interested in it and you want to read more around it. So again, I'm assuming you've read through this question. If not, please pause and work through it. So you're asked two requirements in part A, part 1 should I say, provide the journal entries for 2 years, December 15 and December 16, and also explain the management decision to undertake this revaluation in terms of the debt hypothesis, the management compensation, which is the bonus plan hypothesis, and the political cost hypothesis. So we're trying to explain, does this make sense? Does this choice of revaluation model make sense under each of the hypotheses? So Kahuna Company on the 1st of January 15, it purchased a property, useful life of 50 years, and it decided to account for it under the cost model. However, fast forward a year, on the 1st of January 16, it decided to then account for it under the revaluation model. Because remember, you have a choice under IAS 16. And you would have covered this in AF1 in your accounting module, and we'll cover it again in semester 2 in AF2. And what we're looking at here is we're asked to do the journal entries in 15 and 16, and then, so we're doing the revaluation journals as well, and then explain whether this makes sense under each of the hypotheses. So let's start initially with the journal entries. Quick revision of IAS 16, but this is often how this question appears in practice, because you will be asked to integrate it into a core accounting technical concept. So we come down then to question 1, and we look at part A. So we'll say journal entries for 2015. Well, the first one is an easy one. It's going to be debit property, or we'll call it PPE, and credit bank. And that is going to be 100. So you're told it's 100 million. So we'll just do 100. We'll drop the millions off to make it easier for calculations. If you did out 100 million, that's fine as well. And what now you can give the narrative you wish, being the acquisition of property for cash. So just say you paid in cash, i.e. you paid through the bank. If you said by check, that's fine as well. So we're told in 15, they acquired a property for $100 million. Useful life of 50 years and using the cost model. That means you will charge depreciation under the cost model will be 100 over 50, which is 2 million per annum. So I said, I'm summarizing it. I'm dropping the millions off to make it easier. You don't have to. You can leave it full. And your debit and credit for depreciation in a year. Debit depreciation in the SOPL. Credit accumulated depreciation in the statement of financial position. 2 and 2. So what we're saying then at the end of 2015, at the 31st of 12/15, your net book value, otherwise known as your carrying amount, is 100 minus 2, which is 98. So that's our closing position at the end of 15. There's no revaluation model in 2015, if you go back to the question. They didn't choose that until the 1st of January 2016. So at the end of 15, you merely hold it at cost less accumulated depreciation. We have no impairment in this question. However, at the start of the next year, they want to revalue it to 110 million and a useful life of 50 years. So for 2016, if I bring it down, 2016, your net book value at the revaluation date, which is the first 16, was 98, and your revalued amount, we're told in the question, was 110. So this clearly is a revaluation gain. This is under IAS 16, a revaluation gain of 12. So that's your first step always, if you remember back to IAS 16 in your AF1 studies. Calculate the revaluation gain or loss. Compare the net book value, and be careful, because we are revaluing it at the 1st of January 2016, that means we don't charge depreciation until after the revaluation takes place. Right? If we were doing the revaluation at the 31st of December 2016, then we would charge depreciation for that period as well. So in our case here, what you do is you get rid of accumulated depreciation and you put it against the PP cost. We always do that initially, 2 and 2. So your accumulated depreciation, this is now nil. 2 minus 2 equals 0. For your PP cost, this is now 100 minus 2 equals 98. So your first step always when you're revaluing is net the accumulated depreciation against the asset cost account. So you clear out accumulated depreciation and you put the asset cost down to the net book value. It was originally in at 100 and now it is down to 2 less, which is 98, which is its net book value. The second step you always have in a revaluation is you recognize the gain or loss. So in our case, you're going to debit PP cost 12. So this is now 98 plus 12, 110. And credit revaluation surplus, which goes through your OCI. And that is now 12 because it's the only one in it. So you'll see what we do is when the revaluation is complete, you always want the cost account to be the revalued amount. Our cost account now is 110. That's where we want it to be. We want it to be the revalued amount. And you always want the accumulated depreciation to be nil. You clear it out and start from scratch. So they are your journal entries for 2016. Clear out accumulated depreciation, adjust the cost account, and because it's a revaluation gain, it goes through OCI, and we call that your revaluation surplus. So it's a separate line item in the equity section of the statement of financial position. And the other thing where a lot of students forget is you need to charge depreciation now for 2016. If this revaluation happened at the end of the year, you charge depreciation before the revaluation. Now you charge it afterwards because you revalued at the start of the year. So it's now 110 over 50, and that will be, if we do the calculation out, 2.2 million. So it's the same journal entries as previously: debit depreciation, SOPL, credit accumulated depreciation, 2.2, 2.2. Let's just watch. When you revalue, you use the updated figures, the 110, and the updated useful life, 50 years. If they didn't tell you anything about the new useful life, you would assume the useful life was 49 years. 50 years at the start, 1 year used up, so it would be 49. But the fact that they've told us here it's 50 years, we use that as the basis instead. So the net book value, if we want to do it here, just to show you, the net book value at the end of 2016, the cost account is now 110 and depreciation is 2.2. So it's 110. Remember, we cleared out all the accumulated depreciation, so we're starting from scratch again. So that the net book value is 107.8 at the end of 2016. Now that was a basic enough focus on accounting for a revaluation under IAS 16. It should be a refresher. We will cover it again, don't worry, when we get to it in semester 2, but we'll cover it at a bit of a quicker pace. So it's important that you go back and refresh your knowledge of that as much as possible before we come back for semester 2. So that was your first port of call in your question 1, was part A asking you to provide the journal entries for both years. But we're also asked in part B, does each of these hypotheses help explain the decision to undertake the asset valuation? So if we want to summarize in part B, what is the summary impact of choosing the revaluation model instead of the cost model? What is the summary impact? Depreciation increases from 2 million to 2.2 million. That means profits decrease. So because you've revalued the asset, that means your profits are going down because your depreciation expense, all else being equal, is going up. That's our first key impact that we're looking at. Second thing we look at is asset value has increased. Now net book value is 107.8 million versus only 98 million last year. So your asset values have gone up and your OCI has increased. Now your OCI is a separate section, other comprehensive income, of the statement of profit and loss. It's probably less important to investors than the core profit figure, but it still is a movement. So if we look at each one then, will our hypotheses explain it? Will the debt hypothesis, will the bonus hypothesis, which is the management compensation hypothesis, and will the political cost hypothesis, will these each explain it? So if we start with the debt one, will this explain the choice, right? This will help explain the choice if the company has debt covenants based on total assets. As total assets have increased, that means the covenant will look better to the bank. So what we mean by that is if you have a covenant, for example, having a certain total assets figure or having a certain gearing ratio, well, if you increase your equity because you're increasing the asset values, that's going to reduce your gearing ratio. So it's going to make you look better to the bank. So it will help explain it if that was the situation. We don't know, but we're trying to say, would it help explain? It would help explain there. This hypothesis would not help explain the choice if covenants were based on profits, as profits actually decrease. So it wouldn't explain a company choosing the revaluation model if you had a debt covenant based on profits. For example, interest cover is based on profits. So if there's a debt condition or an interest cover, this debt hypothesis would not explain why a company would choose the revaluation model over the cost model, because you're actually decreasing your profits, which would make your debt covenant look worse. Right? So here, for the bonus hypothesis, this change would not be explainable by the bonus hypothesis. Why? Profits actually fall, which would mean a bonus based on profits would fall also. So this doesn't make sense. So the bonus hypothesis cannot explain why this choice would take place. If anything, if there was a bonus there based on profits, the management would choose to continue with the cost model, which would give you a lower depreciation figure and a higher profit figure. Now we're ignoring the fact that OCI has gone up. I know that's part of the statement of profit or loss and other comprehensive income, but usually bonuses might be based on core profit figure before OCI is taken into account. So just bear that in mind. And finally, then the political cost. Would this be explained? This could help explain the change, as by lowering profits, the company may help reduce its political exposure. Now, it's only a marginal decrease because only 200,000 bigger depreciation, but by having a lower profit figure, you're helping reduce your attention from the public, and that means reducing your political exposure for increased regulation, etc. So the political cost hypothesis might help explain why they choose the revaluation model to have a bigger depreciation expense to reduce their profits. So again, for each of these, you're only conjecturing how it might help. So you have to explain, well, what does the hypothesis mean? And then explain, well, can I see this helping explain the choice of going from a cost model to a evaluation model? Right, so just make sure you're happy enough with that and go back over the explanation. And particularly if you're not sure, go back over what each of these mean in your notes and in the recordings to the lectures that are available on Loop. The question 2 is very similar in nature. We're looking at another question 2. We're looking at another topic from your AF1 studies. So you're told a listed company, Turner PLC, is required to make a provision. Remember, a provision for a court case that would be dealt under IAS 37. And you're told there's an estimate between 30 and 50 million of the eventual costs. And the directors have ultimately decided to take their best judgment and create a provision for 30. They could have created a provision for 50, but they decided, no, let's make a judgment, let's use 30. So remember, by choosing a lower provision, that is giving you higher profits. So we're trying to figure out then, does this make sense? Will any of these hypotheses help explain it? Right? So let's take each one in turn. Discuss if that debt hypothesis of positive accounting theory can be used to explain this change in accounting policy. Right? Well, there's two aspects to this. If you have debt covenants, debt conditions tied to profitability, then it will help explain the choice of 30 million. Why? By choosing the lower provision, you are increasing your profits, and higher profits mean you look better to the bank. So that means that does make sense. The debt hypothesis can help explain this change or choice of accounting policy is probably a better one there. By choosing the lower provision, you increase your profits, and by increasing your profits, you relax your debt covenants. Higher profits means you look better to the bank. So the debt hypothesis could be used to help explain it. It not mean it does explain it, but it can be used to help explain it. Similar logic for the bonus plan hypothesis. By choosing a lower provision, you have a higher profit. And if your bonus, so management bonuses, is based on profitability, then this bonus hypothesis can help explain why a manager would choose 30 million instead of choosing 50 million. By choosing the 30 million, you lower your costs and you increase your profits. And higher profits means higher bonuses. And that's what's predicted by positive accounting theory. Finally, then, political cost. This would not help explain this choice, because we know in political cost hypotheses, you're trying to reduce your profits because you're trying to reduce your political attention that might draw attention from the public, which will draw complaints that this company is too profitable. So if political cost hypotheses was trying to predict, they would predict the choice of 50 million, because you choose a higher provision, which means higher costs and ultimately lower profitability. And the lower the profitability, the less political attention and public attention will be drawn to the company. So again, we're just trying to show you these are short enough answers when you see them coming out, but we want you to be able to explain through each one. What does the debt hypothesis predict? Can that help reconcile what the company's actually chosen there? What does the bonus plan or the political cost hypothesis predict? And can that be used to help explain it? It may not exactly explain it, but we're trying to get you to articulate your knowledge of what the hypothesis is, number one, and apply it to the particular scenario. So make sure you go back over both of those questions, the journal entries and the key explanations, and go back and look at your question pack, which covers positive accounting theory as well. There's one or two extra questions on that, as well as work solutions. Right. So in this week's tutorial then, it was a shorter tutorial than normal. We're looking at positive accounting theory. And what we're trying to do is to see, do we understand the core basics of positive accounting theory, i.e. the different aspects of it, and then can we apply it to a particular scenario? And oftentimes how positive accounting theory comes up, it's part of another standard. So IAS 16, or in this case IAS 37 for question 2. So know the core basics, but be confident then to be able to apply your knowledge as well. So that was this week's tutorial.